So thank you very much, Richard, for this introduction, and thank you for giving me the opportunity to present this lecture. So this is a delicate exercise. I was asked to give a lecture which can appeal to a wide audience. So I decided to speak about this topic, systemic risk, because I think that there's some interesting mathematics involved, but it also touches some issues which many other people outside the narrow specialization of our discipline can relate to. So but the field in which I'm working is probability theory and random processes and their application to the modeling of financial markets. And this is a long story which started a century ago. And the starting point is the observation that if you look at prices in financial markets, not only prices, but other quantities such as indices, exchange rates, interest rates, these variables exhibit a highly irregular behavior as a function of time. So some examples are plotted in these figures. In the figure above, you see the evolution in time of a financial index. The S&P 500 index is the average of the values of 500 largest US stocks. And in the graph below, you see the VIX volatility index. So this index tracks the volatility or variability of stocks in the US market. And these quantities, these graphs are typical. If you display any stock price or exchange rate as a function of time, you see something like this. So these variations are typically very difficult to predict, if not unpredictable. And this results in some uncertainty in the economic values of investments, savings, and pensions. And this uncertainty needs to be quantified. So the first person who took up this challenge was the French mathematician, and also he was a former trader, Louis Bachelier, who in his doctoral thesis under Henri Poincaré in 1900 had the ambition to build a theory of speculation. That's the title of his thesis. And there's a nice translation by a colleague, Mark Davis, by the way. So his proposal, which at that time was completely new, was to represent the evolution of market prices, in particular stock market prices, as a random process. So represent this uncertainty through the language of probability theory. And so a phrase that appears in his thesis is, the only law which governs markets is the law of randomness. And that's very common, and that's something which is very commonly used today in econometrics and finance, but at that time it was totally revolutionary because he was suggesting that a structure which was, a market which is basically composed of human traders, so you're looking at basically the outcome of human behavior, can be modeled through the laws of mathematics, and this was completely revolutionary, and in fact, it was not very well received. This idea took 50 years to be accepted in the scientific community. So, this idea was taken up by many people subsequently. And so in Bachelier's initial proposal, his idea was to model the behavior of market prices to a particular random process, namely Brownian motion. And later, other people revisited this by looking at market data more closely, and they noticed that Brownian motion represents a mild form of randomness, but if you look at price fluctuations, they're actually less regular than Brownian motion. So in particular, Benoit Mandelbrot studied a variety of market prices time series in the 1960s. And he noticed that financial risk is concentrated in time, and there can be discontinuities in prices and so on. So for example, if you look at the index like the S&P 500 that I showed you earlier, there can be days on which there is a large fall in the price, and this large discontinuity or jump can wipe out the entire value accumulated over several years. So the idea was that this idea developed over the years, and it has been the focus of development of many statistical models for financial data with various features. We call them heavy tails, discontinuities, bursts of volatility. So this led to a huge literature in the last 50 years. And so once people were able to quantify this uncertainty through probability, then the idea came to actually control this uncertainty. So this seems very ambitious, but that was exactly what people were trying to do. So there were various attempts at this, and this led to the field of quantitative finance as we know it today. So on one hand, one of these attempts was to understand the risk of investment portfolios and use the idea of quantifying risk to understand how investments can be optimally allocated, how portfolios can be optimally diversified. So this is the so-called portfolio theory, which was born with the PhD thesis of Harry Markowitz, whose photo is missing. It's a blank there. And then in the 70s, we had the development of option pricing theory by Black-Scholes and Merton, whose pictures are there. And here the idea was to develop a theory for valuing uncertainty, to understand the value of contracts with uncertain cash flows. And then there were further developments, how to integrate uncertainty in interest rates, in credit risk and default, and so on. And all these approaches were based on the same premise, representing various types of financial risk through random processes affecting the values of investment. And then once you have a good representation of these risks, or you think you have a good representation of these risks, focusing on minimizing the risk of these portfolios, or focusing on minimizing the risk of an investor under some given objectives on the return. And these models have been widely used and continue to be used by banks, financial institutions, regulators, fund managers, and so on. And if you think about it, so the development of this field of quantitative finance was largely independent from economics. And this is really not something very natural, because if you think about it, a layperson thinks of finance of having a strong connection with the economy. So intuitively, the behavior of financial markets should have some link with the economy at large. And in fact, financial institutions borrow from investors, they lend to firms and households, so there is a connection between the financial sector and the economy. But this financial theory, the theory of quantitative finance, whether mathematical or not, in fact, largely developed as an autonomous field, independently of any strong link with macroeconomics. And in turn, the field of macroeconomics had its own independent development, which largely ignored the role of the financial sector. So the financial sector, of course, was acknowledged as being there, but it was largely modeled as an intermediary, which transmits the money supply from the central bank to the borrowers, and not as something playing a key role in the theory. However, what happened in the real world was that, especially in the 90s and in the 80s, a little bit, the financial sector in the Western economies, especially in the US, grew exponentially, especially with the development of securitization and the introduction of a wide variety of derivatives. And this financial sector came to represent a huge proportion of the economies of developed countries. And with this new role, the financial sector was itself not just a pass-through, a passive component of the economy, but itself contributing to the buildup of large imbalances and creating linkages across the sectors and across countries. And this was understood by observers, but they held it as a necessary consequence of globalization. And most people considered this as a good thing. Integration, globalization, these were the words used to describe these things. But the consequences of this, both for the theory in terms of understanding the risks, and the practical consequences of this for managing this risk, were not really realized until what we know happened, the financial crisis of 2007, 2008. So, and I think that this is an instance where lots of questions in macroeconomics encountered lots of questions in finance, and people started understanding that these were really very connected, and they couldn't neglect this strong link. And today, what we see is the emergence of a new field called macro finance, and this is exactly from the realization that these two things are relating. So what happened during the financial crisis? I'm not going to spend my remaining time explaining what happened during the financial crisis, and there are many people who have done that before me in a much more detailed way. But for us, what's important is to realize that, well, in the quantitative risk models that were developed and used by banks and regulators, they really looked at financial risk as something exogenous, something happening in the economy or in the outside world, and then this event was reflected in financial prices, so some outside shock hitting the financial sector. And of course, in this instance, we did have an outside shock. That was the default of the so-called subprime mortgage loans in the U.S. So these were risky loans that were given out under lax lending standards. But initially, when people, including the Federal Reserve, estimated the magnitude of this subprime market, they said, well, okay, at most it's 400 billion. Of course, for us, it's a lot of money. But at the scale of the U.S. economy, it was something that they thought that the U.S. economy could bear, but without collapsing or without any major hit. So, and actually, there was a speech, a famous speech by Ben Bernanke, who was at that time the governor of the Federal Reserve, and he said exactly that in summer 2008. However, very quickly, people realized that that was not the case. So first of all, several large banks failed, and then that was followed by a dozen of smaller bank failures, and then it spread to other countries. There was spectacular bank defaults in the UK, many bank failures in Europe, many funds failed, and especially the failure of Lehman Brothers in September 2008 was the onset of a period of huge market turbulence which affected markets across the world. And well, there are various ways to quantify what the resulting loss was, but any kind of accounting of the losses leads to figures in the trillions. So the question here is not why did the homeowners default? That's an interesting question. But for us, the question is, why did an initial shock of around hundreds of billions, 400 billions at maximum, lead to, and which was very localized geographically and sector-wise, why did such an initial shock result in widespread loss across the world, across sectors, across asset classes, which figures in the trillion? So there is an amplification that we need to understand. And of course, what we know is that this had a lot of consequences on the economy, not just the financial sector, but there was a loss of investment, therefore loss of jobs, and difficulty to borrow for firms and families and so on. So, and if we look at, so here are some pictures relating to what happened. So first of all, the largest, let's say, imbalance that one can say triggered the crisis was the fall in home values. So here you have a history of home values compiled by the economist Robert Shiller. So his index, called the Case-Shiller Index, is an average of home values in different locations in the US. And this goes back to 1890. And if you look at it, you clearly see that there is a huge buildup of home prices from 2000 to 2008, and then at this point, the bubble bursts, and you have a huge fall in these same home prices. Okay, so here is, the trigger. But then, if you think about, so the common recommendations, the common strategies, which were the outcome of portfolio theory, optimal investment theory, they said, well, don't put all your eggs in one basket. If you diversify, and if you don't invest all your money in housing, then you should be fine, because not everything will move together, not everything will fall together. And that's what failed during this crisis. We saw that investments which were supposed to move not independently, but in a way that could possibly compensate the losses of each other during a fall in one category of investments. This didn't happen. The diversification, which was expected from the statistical study of the values of these assets, did not happen. And we saw things like this. We saw a sudden increase in correlation not only inside the different markets, but across markets in a simultaneous, synchronized way. So this is an index which represents the average correlations across stock returns in two different indices in Europe and the US. So what we see is that these correlations will ramp up. It means a portfolio invested in each index, a diversified portfolio, would see its risk increase, so there's no diversification inside the index, but also they ramp up simultaneously. So even if you're diversified across Europe and the US, well, it doesn't really help at this period. So, and also, if you looked at the correlation between the different classes of investments, so for example, the subprime and stocks, so if investors had invested in these subprime loans thinking they were good investments, and simultaneously they held stocks. Well, if you looked at the correlations of these things before the crisis, they were negative, so it means that holding one and the other were helpful because they moved in opposite directions typically, so that diversified your loss. If subprimes went down, the stocks would have gone up probably, so that would help. But if you looked at the same correlations, this is this column here, during the crisis, the signs of the correlation changed. So again, the diversification expected from these historical models, so these statistical models, did not occur. So the main question for quantitative risk management as a discipline is, what do we really learn from this? So one thing that we can observe, and of course here you can ask the question from the point of view of macroeconomics and the point of view of quantitative risk management. As I said, they had developed largely independently, and in this instance, that was a question that was relevant to both disciplines. So here I will try to answer the question from the point of view of quantitative finance, and I leave it to macroeconomists to answer the relevant questions from their viewpoint. But from the point of view of quantitative risk modeling, clearly what we see is that even the sophisticated statistical models that people had developed to represent risk of portfolios always consider these risks as exogenous random processes. So there were some random variables which were out there. We didn't really ask where they came from, and they hit your portfolio and materials into losses. So all you could do is try to estimate the distributions of these random variables, and then try to calculate your risk and maybe try to hedge it or minimize it. But what we saw during the crisis is that although the initial shocks to the financial sector were from the outside, they were due to homeowner defaults, the subsequent losses were largely generated by the financial system itself through interactions of its components, and the internal dynamics of the financial system amplified these losses. So that was not something that you could capture statistically by looking at recurrent events in the past, because that's what statistics is for. So the magnitude and even the existence of this contagion phenomena across institutions was not taken into account in the models, either in the macroeconomic models used by central banks or in the quantitative models used by portfolio managers. So what are the attitudes one can adopt in the face of this reality? Well, option one is to ignore this and continue to do the same thing as before. And believe it or not, some people do adopt this option because it's easier. It's called the principle of least action, I believe. Okay. Option two, which is actually quite widespread among practitioners, is the so-called black swan theory. The black swan theory says, there's a famous book which you can find in any airport or train station, which says, well, look at these models. They blatantly failed. Every time there was a crisis and portfolios lost 20%, the models failed. That's not a good record. That's not a good track record. So what this point of view tries to claim is that these instances are totally unpredictable events. You cannot really model them statistically. So this argument is used as a premise to reject statistical modeling of risk and with that all mathematical risk models. And this may seem extreme, but actually one cannot just dismiss that with a wave of a hand. There's some convincing to do here, because there is some truth to the facts that underlie this point of view. So option 3 is the one that I would like to promote, and that's why I'm giving this talk, is to actually try to go back and understand these mechanisms, the mechanisms underlying such large-scale instabilities in the financial system and the resulting systemic history, but try to understand what's happening in these instances. And I think that actually this is a very interesting opportunity because one can think of the financial crisis as a Michelson-Morley moment for financial theory. But just as this experiment of Michelson and Morley, led people to think about classical physics at the end of the 19th century, and this led to a new viewpoint on many things that people thought were completely understood. Maybe this is a nice occasion for revisiting a lot of things and trying to see what's really relevant in understanding financial risks. So this leads to the concept of systemic risk. So systemic risk can be defined as the risk related to scenarios where not just one stock goes down or one portfolio has a loss or one bank defaults, but where large-scale instabilities and losses occur across the financial system that affect simultaneously a large number of portfolios and financial institutions, and sometimes to the point of paralyzing them. So, and that's what we really would like to understand in this context. And of course, this is not really a new topic. There has been a lot of literature in the economics literature in particular on this idea of systemic risk. And there are a lot of mechanisms which have been pointed out, and there's a lot of qualitative insights into these mechanisms. But what's really new is that now lots of other people, including regulators and risk managers and investors, are interested in this. And they are not content with qualitative insight. They want numbers. They want to compute things, they want to monitor things. They want to devise regulations and rules. So this needs some quantitative insights because it's not enough to say leverage increases risk. They want to know how much leverage can I allow without destabilizing system. Everybody will understand that a capital ratio requirement for banks will have some effect in stabilizing banks, but people want to know what should be the right capital requirement. Is it too high? Is it too low? So that's where the mathematical modeling comes in. So here are some mechanisms which have been observed to play a role in systemic risk in past crises, and which have been the object of studies in the literature. So one is the idea of systematic risk, which is distinct from systemic risk. The fact that portfolios have the same things in them, so they're exposures to common risk factors. So all banks will lend to homeowners, so they're exposed to housing prices. So this leads to simultaneous losses if these prices fall. And that's what we observed, for example, in the housing crisis. When the house prices fell, we saw that a lot of banks had losses. So that's really easy to understand. Then the other mechanism is counterparty risk. So this is by the idea of that if I lend to you and you default, you fail to pay me back, then I have a loss. Then if my loss is large enough, I fail to pay but the person from whom I borrowed, and this can lead to a chain of contagion that can result in a large-scale failure of many institutions. Then what we also saw is so this is a network relation of counterparty relations in which contagion can occur. A third mechanism, but through which contagion can occur, is through funding relations, the lending and borrowing relations, where this time, instead of the borrower defaulting and not paying back the money to the lender stops lending to the borrower, so they cut off the funding. And this also occurred during by the 2008 financial crisis. And then another mechanism that we'll talk about a little bit is what we can call price-mediated contagion. So this is a mechanism whereby I'm in trouble, so I have to sell what I have in my portfolio. So I sell quickly everything I have in my portfolio. I sell all my shares, I sell my bonds, and so on. And by doing so, I push the price down because I sell a lot of it, so I push the price down. Now, you hold the same thing in your portfolio, so you see the price going down, so it translates into a loss for you. And then if the loss is large enough for you, you might be forced to sell also part of your portfolio, and this goes on and on. So these are all mechanisms whereby the initial loss or the initial shock to one or several portfolios can propagate to others. Okay, so and each of these mechanisms can be viewed as a contagion process on some underlying network. So the idea is that we have these financial institutions, but instead of, as in the classical model, you looking at each portfolio alone as being hit by external sources of loss, which are just modeled statistically, actually the sources of loss can be the other financial institutions, and so we can look at this as elements of a network. And the links that lead to this contagion lead to actually different notions of networks. So the ingredients of the network, the nodes are always the same, they're financial institutions, but the links in the different contagion mechanisms are different. What makes one node close to another can be either the fact that they have a direct transaction link, so that's in the balance sheet contagion picture. That may be the lending relations in the liquid network, or it can be the fact that I hold the same thing as you in my portfolio, so we're close in the sense of if I sell things, then you're affected. Okay, so all these things may be studied as contagion in some underlying network, but I insist on the fact that there are various networks to be considered for one for each mechanism of contagion. And this has led to a lot of interest in studying these models from a mathematical point of view in the recent years. So here I would like to say a few words about this and what we've done in our group and what can be said about some of these contagion mechanisms. So the simplest contagion mechanism that one can try to describe is the idea of balance sheet contagion through counterparty risk. So the idea is that if I look at the banks in a given country, so for example, here you have the graph of the network of all financial institutions in Brazil. So each node is one bank or one credit institution, and then the links represent exposures. So exposures can be through lending and borrowing. I'm exposed to your default if I lend my money to you, but there are also other types of financial transactions, not just lending and borrowing, that there can be derivative transactions or more complex transactions. So in these models, we look at the exposure of a bank to another bank. So we can summarize this in a matrix EIJ, where EIJ is the exposure of I to J. And then we try to understand what happens to the network, what is the loss of other banks if a given bank defaults. And these network models have been studied in the finance literature for a long time. So this has been, in particular, pioneered by the work of Franklin Allen and Douglas Gale, and we're very happy to have them both here at Imperial College. So it's a nice occasion for welcoming them here. And so the idea of these network models, there are various flavors to these network models. One way of looking at the network models is that each node of this network is, if you think of it as a bank or financial institution, so each bank has a balance sheet, so their assets and liabilities, and on the balance sheet there is a component which is called the equity or the capital of the bank. And you can think of this equity or capital as a buffer which can absorb the losses of the bank. So if you look at the orange tranche there, that's the maximum loss that the bank can absorb without defaulting or becoming insolvent. Okay, then you start from a network of exposures of different banks. So each node is a bank here. So on each node, I have a number which denotes the equity or capital of that bank. And here are the exposures. So B has lent 7 to A, D has lent 5 to A, and so on. So in this example, if bank A defaults, well, B loses 7 and D loses 5. So D has an equity of 10, so it can absorb up to 10 of loss. B can absorb only up to 5 of loss. So in this example, the default of A will lead to the default of B because B does not have enough capital to withstand this loss, whereas D is still solvent since it has an equity of 10, so it can withstand the loss of 5 but without failing. Okay, now what happens is that unfortunately, since now B has defaulted and D has also lent to B, now this time this exposure will kill D, because now the total loss of D will be 5 plus 9, and that exceeds its initial capital. So this can continue, and this can lead to a contagion process. In this example, if you iterate this process, this leads to 3 iterations, and then it stops. And in this case, what we see is that the initial default of one node, node A, led to 3 more defaults, B, C, and D. So this is what you can call contagious defaults, and this is an example of balance sheet contagion. Okay, so if you look at it in this way, well, it means that you need to take into account the interconnectivity of banks, not just what's inside the bank's portfolio, as is the traditional point of view of portfolio risk management, but you need to also take into account the connections between banks. So here, this is a very stylized model. These connections can be borrowing and lending, that's the easiest thing to think of, but it can also be funding relations, so that pertains to the short-term component of the balance sheet. And if you do this, then you get a network model, you have exposures and capital, then the question is, well, what can you say about the stability of this network? And a lot of the focus of regulators in the wake of the crisis has been on changing the network. How can we change the financial architecture, the structure of the network, in order to make it stable? So this assumes that we can understand the relation between stability of the network and its structure. So that's a difficult question, because the network, as we saw it in this picture, the network structure in these banking networks is pretty complex. It's not a regular network or something that we can easily understand. So it turns out that these networks are highly concentrated and heterogeneous. But one way to look at this from a mathematician's point of view is to look at what happens in large networks and try to use limit theorems, where you take a network, you endow it with some random structure which tries to mimic the statistical features of links observed in the actual banking network. And then you study a contagion process on this network, and this can be done through Markov chains that describe how the loss propagates on this network. And then if you do it on a finite network, you can describe it, iteratively, but it's very difficult to understand what happens, what's the actual size of the loss, and so on. It's easy to simulate, but it's not easy to understand that analytically. So one way to do this is to say, well, we look at the limit when the number of nodes goes to infinity, and actually it turns out that infinity is simpler to understand than 5 or 10 or 50. Okay, that's not easy to understand for a non-mathematician, but that's true. So if you do this, then you can get some insight into what are the network features which determine stability. And this is a project that we undertook with Hamed Amini and Andrea Minka, but 2 bright graduate students who worked with me on this topic. And the offshoot is that there are 2 quantities which do matter in this network structure, and not only 2. One is, well, the connectivity, of course, that's intuitive, or the topology of the network. So that's encoded in the distribution of number of incoming links or number of outgoing links, or in degree and out degree. So in the financial interpretation is each node has J debtors and K creditors. I lend to J persons, I borrow from K entities, and this quantity here, but mu Jk is the proportion of links with J debtors and K creditors exactly. So that defines the statistical description of the topology of the network. And the other thing, of course, is how much capital the nodes have, and that's what we denote here by QJK. This is the fraction of overexposed nodes. So nodes or banks which have at least one exposure which exceeds their capital. They have a large exposure, in other words. And so it turns out that in these large network limits, if a certain combination of the topology and this fraction of overexposed nodes exceeds some threshold, then contagion becomes large scale. Otherwise, it's contained. The contagion will remain contained. So that's an interesting insight, because this ingredient, the topology of the network, you can't really control it. Banks have links with clients, and that's what it is. But this other quantity here, the fraction of overexposed nodes, overexposed means that they do not have enough capital to cover their exposure. So it means that this is an ingredient that the regulator, for example, can monitor or act on. And so this fraction here can be increased or decreased by depending on the regulations imposed on each node. So, okay, so, and in fact, if you now think about this so if you think of this network now, not the network we observe today, but if we try to project this network in a stress scenario where, banks lose some of their capital due to a market shock, you can think of this scenario as being parameterized by shock size Z, where Z is the loss in the capital of banks in percentage. Then, well, if you keep everything the same and you decrease the value of the capital buffer of banks by Z%, well, you're going to keep the same network topology, but you're going to decrease the level of capital, so you're going to increase the proportion of overexposed nodes because they have the same exposures but less capital. So this means that if we start from a stable network, which verifies the stability condition, and then we impose a shock due to some macroeconomic stress scenario, eventually this shock might be large enough so that this inequality is reversed. So this means that there is a maximal shock size that a network can bear while remaining resilient, and this maximal shock size, Z star, is the solution to the equation with an equality. So and this also means that if you start from a stable network, a network which is stable to contagion, and then you apply to it a shock of a given size, when you increase it, there's the stability does not deteriorate gradually because there's an inequality. Once this inequality fails, then all of a sudden you become unstable. So this means there's a tipping point in these network models. There's a tipping point. If the shock size is large enough, all of a sudden the size of a contagion will become macroscopic, and you go from a stable phase into an unstable phase, but not gradually, but very rapidly. So there's something that you can qualify as the onset of contagion in these models, and this onset of contagion is a way of looking at the resilience of the network. And these things in stylized models of networks, these things can be calculated and quantified in terms of the limit theorems obtained through probabilistic means. For a given network which is finite, this is a much more difficult question because we have finite size effects and so on, but this leads to some insights into this this phenomena. And also another insight which comes from these models that I think is interesting is that if you think about it, network models, in these network models, contagion takes place through links. And this means that if you're interested in containing contagion, limiting contagion, you should be acting on the links. And this is really opposite to the type of rules that have been devised in banking regulation, because banking regulation has focused on banks, which are the nodes of the network, rather than the links. So, for example, there are capital requirements for banks, and the capital requirements are exemplified through what's called the capital ratio. So the capital ratio says you take the portfolio of a bank, you take you take the size of all its assets, the size of its portfolio. So let's say it's lending 100 billion, and then you require that it holds a capital that has a minimal ratio to the size of its assets. Let's say it's 8%. So it means that you should hold, in this example where you lend 100 billion, you should hold 8 billion of capital against the 100 billion. And that's supposed to be the right buffer. So this point of view says, well, the size of the portfolio doesn't tell you about the role of the bank as a systemic node or not in the network, because that has to do with connectivity, and that has to do with the positioning of the node in the network. So you should be really thinking also about the role of the links, and in this model, it's natural to look at the links which carry the largest exposures, because contagion takes place through these links which carry the large exposure. So, and that means that here, a more natural ratio to look at is the ratio not of the total number of the sum of exposures to capital, which is the usual capital ratio, but the ratio of the largest exposure to capital, which is what we call the capital to exposure ratio. So it's, instead of taking the sum of all the outgoing links, you take the max of the weights on the outgoing links, and that's what's going to define the fragility of that part of the network, because it defines whether contagion stops there or it continues to go to propagate from there. And now, if you compare these two different ideas in terms of capital requirements, well, one way to compare them is to say, well, okay, I'm going to take the same network, same portfolios, okay, they hold the same assets, but now I'm going to compare two different types of capital requirements, one based on the ratio of capital to total exposures, that's the usual thing, and the other one is based on the ratio of capital to maximal exposure. So I look at the weakest link going out of a node, and I make sure that I have enough capital to cover that. So if we do this, this graph is exactly this exercise that we did for the Brazilian financial system. We had a lot of data from the Brazilian Central Bank. And so what we did is we compared these two things in terms of efficiency in reducing systemic risk. So this is a metric for systemic risk of the Brazilian banking system. So I don't go to details here. This is basically the loss induced by the default of the 5 most systemic banks. And here is in each scheme, so each scheme is a different color. The scheme where you apply the same capital ratio to all institutions is shown in blue, and the scheme where you apply this per capital to exposure ratio, so you penalize the large exposures by requiring more capital, is shown in red. So what we see is that in this scheme, you can actually have, if you allocate the capital requirements according to the links instead of the node size, so link size instead of node size, that's what we propose here, you can actually achieve a lower degree of systemic risk by, while at the same time requiring the same amount of capital or even less capital. So this means that, and that's really something natural if you think about it in terms of other network disciplines. So people who look at computer security, for example, they've thought about this stability of networks to virus propagation and so on. Their first attempt is to secure the links between the main servers. Of course, you can install antiviruses on all servers, but if you once the server has been contaminated, that's done. So what you need to do is to secure the links out, that go out from these servers, and that's exactly the same thing we're trying to see. Okay, so another mechanism for contagion that is quite different, and I'm going to finish with this, is the mechanism that we can call price per mediated contagion. And that's also a mechanism that was observed to play a major role in 2008, in the crisis of 2008, and this can be explained through this figure. So the idea is that most financial institutions, but today have leveraged portfolios, means that they start from a capital of, say, 10. Against this capital, they borrow, say, 90. So this is called leverage of 10. So the portfolio now has a size that is 10 times the initial capital. And then they lend to outside the borrowers by the amount of 100. So that means that their activity is based on the borrowing and then the lending. So there's both simultaneously lending and borrowing. So they do not lend their own money, but they take money from investors and they lend to other investors. So this is the phenomenon of leverage. However, the regulators typically will impose a maximum leverage on them. So this is the same as requiring a minimum capital ratio. So in this example, let's say that the leverage is 10, and the constraint on the portfolio is that leverage cannot exceed 12. So the ratio of the equity to the assets should, the ratio of assets to equity here is 10, but it cannot exceed 12. Now, look at this portfolio, and then you look at the scenario when the assets lose 5% in value. So this is a moderate shock. It's a large shock, but it's not a market crash. It's 5% is something that happens every year. Now, in this example, where of course the assets lose 5 in value, when 95, so the equity is the difference of assets and debt. It becomes 5 now. So now if you look at the new leverage ratio, it's 95 to 5, so it's larger than 12. So now, if you're subject to this leverage constraint, you must sell some of your assets to get back to a level of leverage that is acceptable to the regulator. So it means that in this example, if you do the math, it means that you have to liquidate 35 of your 95 of assets. So it means that for a leveraged portfolio like this, 5% loss can lead to a sale of 35% of the portfolio. And this is simply due to leverage. Leverage magnifies shocks. Okay. Now, if this happens in many portfolios simultaneously, you can see that this will lead many institutions to simultaneously sell a large quantity of assets in a similar shock scenario. And if they have the same composition, this may lead to simultaneous sales of the same assets. And that's where this contagion kicks in. So this contagion phenomenon works in the following way. You start from these leveraged portfolios, then there is some external events, so homeowners default or something like that. There is a initial loss in these portfolios. But since they are leveraged, then they might end up with a leverage that is too high for the regulator or for their managers. So then the leverage constraints are breached, so then they have to sell part of their portfolio to fulfill their leverage constraints. And this simultaneous selling by a large number of institutions will push down the price, which will lead to further losses for other institutions, and they will also be forced to deleverage and so on. So this generates a feedback loop that may continue as long as some portfolios are in breach of their leverage constraints, or until prices hit a level where it's very low and some investors stoop in to buy. And so this can be formalized in terms of a mathematical model for what's called fire sale. So the situation is called in economics fire sale. So fire sale means that you're in a situation where you're forced to sell what you have, not because you want to, but because you don't have enough cash or you don't have enough capital, and you have to sell to raise capital or cash. Okay, okay, so this, so very schematically, what you can understand this as a reaction function of portfolios to loss. So if the loss of an institution is small, okay, they may just withstand this loss and not do anything. But if the loss is large, and if the institution is subject to either capital ratios or leverage ratio constraints, then they start to react and they have to sell some part of their portfolio, some proportion of their portfolio. And the larger the fall in the value, the larger the proportion of the portfolio they have to liquidate. So if you look at the proportion of the fund liquidated as a function of fund value, it's an increasing function. So when you go down, the more you go down, the more you have to sell. And you can also think that if the fall is sharp, you have to accelerate your sell. So you could think of it as a concave function. So this is what we call the deleveraging function. And now, well, the idea is that, well, now if you do this, if you sell a large quantity, you will move the prices. And in particular, if you sell, you're going to push down the price of the things you are going to sell. And so now, if you have a statistical model for your prices, so if the proportional change in the price is some statistical model with risk factors and so on, and in a scenario where a large investor has to sell a large quantity of his or her portfolio, this creates an impact on the price. It's called the market impact or the price impact of the sale, and this can lead to a perturbation in price dynamics that can distort the price dynamics, but during that phase. Okay, and if you look at how this iterates through, this is actually, again, a Markov chain. So you have, you look at the prices and values of portfolios. There are exogenous shocks to these portfolios, so the values change. If the new values but do not result in a large loss of portfolios, fine, we just, continue. But if there's a large loss, this may trigger some fire sales, and the fire sale has an impact on the price. So this will generate an extra term due to distressed selling or fire sales. And that can lead to a feedback loop. This feedback loop is already existent for a single portfolio because my own fire sales can push down the price, which force me to sell more. But it also can lead to losses in other portfolios, and their fire sales can be triggered. So it can be, there's a self-feedback, but there's also a feedback loop in which there's contagion. So there's both feedback and contagion in this phenomena. And it's really a perverse form of contagion because it's generated by selling. So you can limit various activities of financial institutions to limit contagion, but you can't forbid people from selling because buying and selling are most basic operations. So this is really something that is very difficult to control, and all these solutions proposed by regulations such as ring fencing of financial institutions from each other, that works for the previous form of contagion, but this one, you can't really ring fence them in this way because the contagion takes place through the price, through the market price. Okay, and here I skip the details of this model. But one thing that comes out of this is the fact that in this feedback loop, if I hold the same type of portfolio than you, then when I sell part of my portfolio, since we hold the same assets, I will push the price of these assets down, and the portfolios which are going to be affected most are those of investors who hold similar portfolios to mine. Because if I hold exactly the same mix of stocks and bonds and so on, when I sell my portfolio, when I liquidate my portfolio, you're going to be hit exactly since you hold the same assets. So this means that this last part of the feedback loop, so the contagion, will take place in a strong way across portfolios which have similar features. Okay? So now this leads to an interesting discussion which has been brought out in other contexts, in network models, in fact, of the competition between diversification and diversity. So one of the simplest messages of traditional portfolio theory, financial theory, is the idea of diversification. It's very easy to explain, no math needed. The idea is don't put your eggs in one basket. So don't invest all your money in one stock or one type of investment. Put a little bit in each of these different types of investment, because that's good. If one of them goes down, then the other one might save you from having lost all your wealth. And this is clearly optimal at the level of individual investors. If you want to give advice to individual investors, and this is the kind of thing that we teach in the core courses on portfolio theory, you tell them, well, find an optimal mix given the profile of the return you want to have and the level of risk you're willing to bear. So this is something that is followed by all fund managers and investors. But now, what you see here is that if all investors apply similar approaches to diversification, they can all end up with diversified portfolios, but similar portfolios. So I'm diversified, you're diversified, but we're diversified in the same way. So actually, we invest in the same pension fund. So actually, we're diversified exactly in the same way. But that's another issue. So this means, and this might be optimal from the point of view of the investor only looking at his or her portfolio. But if you look at it from a stability point of view, that's not really good, because if you diversify in similar ways, and this is done in the industry through so-called benchmarks, well, these portfolios will end up being huge portfolios or many small portfolios which are very similar, which is exactly the same. And this maximizes the magnitude of contagion when these portfolios start to liquidate, because they will be all liquidating in a similar way. And this leads to a very, very interesting and delicate trade-off between diversification at the individual level and the necessity of diversity at the macro level. And diversity means you have to have strategies or portfolios which are actually filling the portfolio space in a uniform way, and that has nothing to do with the idea of diversification for each portfolio. So that's okay. That's a very interesting problem, and that's actually something that the regulator can contribute to by looking at the extent of diversity in the current market configuration of portfolios and disseminating some sort of aggregate information which can help investors understand where there's crowding and where there is diversity and correctly positioning themselves. So these are things that can be quantified in an interesting way. Okay, so I guess my time is over. So let me end by giving special thanks to a lot of people. So first, those who have inspired me through their teaching and research and encouragement. So here's a list of some people who have played an important role in my research and scientific development. So Henri Berastiki, who couldn't make it today, Jean-Philippe Bouchon, my PhD advisor, Nicole Kakawi, who was my co-advisor during my PhD, and some of the scientists whose teachings I've benefited a lot. Jean-Jacques Cotte, Hans Vollmer, who's here, Benoît Mandelbrot, and the late Paul Malievin, and Jacques Beneveux, who was my first probability professor. I learned everything about probability from him to start with. I've had the chance of working in institutions which have provided an excellent environment for my research. First of all, I started my career in the CNRS in France, at École Polytechnique, and then I spent a few years at Columbia University and University of Paris 6, and now here at Imperial College. And a particular thanks to my colleagues in the Imperial College Mathematical Finance Group, with whom I've had an excellent period in the last 2 years. And also, of course, thanks to my collaborators throughout the years with whom I've done all this work and lots of other things that I didn't have time to talk about. And my friends who are here, and my family for their constant support. And last but not least, a special thanks to my favorite collaborators who are here in the audience. Thank you very much.